David, we got the technical analysis showing how tricky the market really is. Do you buy this rally on a fundamental basis?
Yes, I do, because I think people have been scared about inflation all year. I think the rhetoric about inflation being transitory has been thrown out the window. But in fact, there is some of this that is transitory. And I think that that's really what's been shown by the CPI report yesterday and the PPI report this morning. And, gasoline prices are already down $1. We're seeing falling airline fares. We're seeing plenty of signs that not only is the economy growing at a more moderate pace, but also inflation is coming down. And I think, if that's the case, then the peak for interest rates is going to be lower, and that peak for interest rates that we see will support higher equity prices.
So the Fed is wrong. All the commentary we're getting from the Fed right now, wrong. Kashkari, wrong. Evans, wrong. David, they're all singing from the same hymn sheet right now. You're saying that ultimately they're going to have to eat some humble pie here.
Well, the problem is that they've been on a diet of humble pie for the last year, and I think that's what's causing them to be cautious in declaring any sort of progress here. It is true that there are sticky parts of inflation, wages, owner's equivalent rent. Those things are going to hang around. But owner's equivalent rent is just sort of a nebulous concept. Nobody actually pays owner's equivalent rent. And a little bit of wage gains after years and years of the average worker falling behind is not necessarily a bad thing. So it'll take a while. It'll take a while to get inflation back down to 2%. But so long as we are making progress in that direction, there is no need to tip this economy into recession. And so if you have a period where inflation is slowly coming down, the economy is trudging along, but you're able to maintain margins, I think that's a pretty good outlook for the equity market.
David, why isn't this just a short covering rally? We had an article in Bloomberg talking about hedge funds, quants. They were super short coming into this rally. Why isn't it just that?
Well, that could be part of what's going on day to day. But I think the key thing is it isn't just that we got a good CPI report for July. We're going to get a good one for August also. I think that's going to show a decline in inflation for the month of August. And then, following through in this, we've got a lot of drag in this economy. We've got the federal budget deficit is down 71% year to date. That's taking all this stimulus out of the economy. We've got high mortgage rates, or higher mortgage rates. We've got a high dollar. All that's applying brakes to the economy. It's going to slow inflation down. Increased supply is going to slow inflation down. So I think inflation has been the thing that has hurt the market all year, and I think that is really turning here.
Where do rates go back down to?
Well, I think there's a limit to how far long rates can fall from here. But I mean, we're already down, well below 3%, so that's okay. I do think the Federal Reserve will raise rates 50 basis points in September, 25 basis points in November. Not sure about December, whether they need another rate hike at all. But if you peak out at, the 3 or 3.25% of the federal funds rate, 10-year Treasury yield, not much different from that, that's okay. Those are low rates by historical standards, the low rates relative to underlying inflation. I think that'll be a sort of good backdrop for equity markets.
So, David, there definitely seems to be an idea that lower inflation means it's going to be good for stocks. I get that. On the flip side, though, Mike Wilson at Morgan Stanley pushes it a little bit more. And he says, look, inflation could come down very, very fast. And if that happens, that's a negative for stocks. It's going to hurt the operating leverage that we've kind of come to love so much. What do you think of that argument?
Well, obviously, falling energy prices is going to hurt our energy stocks. That's true. But in general, the real problem that companies face right now is this hot inflation is building up wage demands. This excess of job openings is building up wage demands. That's going to really crush margins. So if you can have a backing off in inflation so the workers feel like, maybe I can't actually ask for that raise, and that stops wage growth from accelerating here, that's really what businesses need. So I think going forward, you'll have lower interest costs that allows companies to help keep their margins high. You'll have slower wage growth. I think all of that is actually positive. So inflation has been the problem. I think lower inflation will be good over the next few years for maintaining profit margins, and therefore good for the stock market.
David, how quickly do we get back to record highs? And do you think those record highs will be justified given that some of the headwinds that we are talking about will still exist for a while?
It might be a while, but it could take it could take 6 months, it could take a year, it could take longer than that. But I think one of the mental exercises I think an investor ought to make is look at the market right now, look at what the record high would be, look at the percentage gain you're talking about here. So if you need to go up 15%, if it takes you a year to do that, that's a great gain. If it takes you 2 years to do that with dividends, that's still a great gain. If it takes you 3 years, you're still making good money. So in order to be a bull on stocks, all you have to believe is that you'll get there within, say, the next 3 years. And I think that's eminently doable.
So, David, does that also imply a weaker dollar?
Yes, I think it does imply a weaker dollar, and we've seen that. The dollar is way too high. You know, I mean, as a matter of policy, it's just a very bad thing. It's been hurting manufacturing jobs for a long time. But if the Federal Reserve turns more dovish or less hawkish, and the U.S. economy is growing more slowly and U.S. inflation backs off, then I think the dollar does come down. Our trade numbers are just dreadful. And I think that will tend to push the dollar down. And of course, it will increase foreign profits for U.S. companies, but it also amplifies the return on international investments overall. So I think, you know, within this market, international equities are clearly cheaper than U.S. equities. Value is cheaper than growth. Mega caps are more expensive than the rest of the market. So there are other opportunities in the market rather than just be in equities at this point.
David, is there any chance that we retest this year's lows? What is the risk if you're wrong and people take your advice?
Well, of course we could retest the lows. It just takes one shock, one big hurricane in the Gulf of Mexico knocking out U.S. refining capacity and pushing gas prices above $5 a gallon. This could happen. And you know, the advice, of course, is has to do with overweights and underweights. The first piece of advice is be diversified. You know, in order to be able to benefit from long economic expansions, you have to be able to weather bad times, and that means be diversified to start with. But you know, the first question is, do you buy the rally? Yes, I would be, you know, fully invested in equities at this point, because I do think that equities can move higher here.
Quick question before we go, David. I understand the dollar weaker call, but what happens if Europe gets into a recession? It feels like that's the base case for a lot of people at this point.
Well, yes, but eventually there will be some settlement probably in Ukraine, and that changes everything. I think we've seen the ECB have done some pretty smart things here. I mean, they are raising rates, and I like the fact that we're getting back to positive rates in Europe, actually. I think that's good for the long run. But they've also put a plan in place to try to protect against the kind of disorderly markets we saw in the European debt crisis. So I think that makes Europe more stable. And you know, the funny thing is, people keep saying Europe's going to go into recession. Hasn't done it yet. They haven't seen a negative quarter from GDP. So I think Europe's actually perhaps in a little better shape than the ECB or European commentators think.